Hello everyone and welcome to Endeavour's Q4 and full year 2022 results webcast. Before we start, please note the usual disclaimer. In addition to the press release and financials, please note that the data center on our website is a great source of information for unit costs, historical financials, reserves and resources, ESG data, and much more. On today's webcast, I will be joined by Sebastian, Mark, Joanna, and Jono. Sebastian will start with a recap of our key accomplishments for 2022, and he will then hand it over to Joanna to talk you through our financial results. Mark will then walk you through the detailed operational results mine by mine before Sebastian gives his concluding remarks. At the end, we will be available for questions. I will now hand it over to Sebastian.
Thank you, Martino, and hello everyone. 2022 was another very successful year for Endeavour. And of course, it was another very busy year. We are extremely proud of what we have accomplished as we delivered against our strategic objectives, despite the changes in the macro and geopolitical environment. To summarize the year, one of our proudest achievements was meeting guidance for the 10th year in a row. Given this strong operational performance and our healthy balance sheet, we were able to launch the Sabodala-Massawa brownfield expansion and construction of our next mine, the greenfield Lafigué project, which will further increase the quality of our portfolio. We also continued our strategy of actively managing our portfolio by divesting our non-core Karma mine. On the exploration front, late last year, we were excited to announce a maiden 3 million ounce discovery at our Tanda-Iguela property in Côte d'Ivoire, which has the potential to be a Tier 1 asset. We were also pleased to see our ESG strategy continue to progress with 5 new initiatives launched by our Endeavour Foundation, successful compliance with the World Gold Council's responsible gold mining principles at our Ity and Houndé mines, and sector-leading ratings from several rating agencies. And lastly, it was nice to see our UK listing gain in momentum with higher liquidity following our inclusion into the FTSE 100. So, as we look back at 22, we can say with confidence that our business has performed well. If we take a closer look at our operating performance last year, in terms of production, we produced 1.4 million ounces, achieving the top end of our guided range, thanks to strong performances from our cornerstone assets. Meanwhile, our all-in sustaining cost amounted to $928 per ounce, which was within the guided range, despite the inflationary pressures that the sector faced. We've of course not been totally immune to these pressures, but we've benefited from the pricing mechanisms which come from our long-term supply contracts, from favorable exchange rate variations, and cost optimization initiatives across our portfolio. As such, we've been able to maintain our position as one of the lowest cost producers in the sector and are pleased to be one of the only companies to have met initial cost guidance. Our low-cost positioning is definitely a strong competitive advantage, and we are pleased that the hard work to reposition our portfolio over recent years is now paying off. As you recall, our goal has been and continues to be to create a resilient business, one that is capable of generating sufficient cash flow to reinvest into the business, fund growth and exploration, while at the same time rewarding all of our stakeholders. And of course, having a low-cost base is key to achieving this. Last year, our strong operating performance generated over $1 billion in operating cash flow, which in turn has allowed us to reinvest $379 million in our mines in the form of sustaining and non-sustaining capital. We also increased our focus on growth by investing $127 million for the Sabodala-Massawa expansion and our Lafigué greenfield project. Given that exploration has been our bread and butter to create value, We maintain our focus with an $80 million exploration program. To our shareholders, we've also returned $300 million, which is double our minimum commitment for the year, demonstrating our commitment to delivering supplemental returns. At the same time, we continue to reward all our stakeholders and return $400 million to our host governments through taxes, royalties, minority interest dividends, which is of course included in the $1 billion operating cash flow figure mentioned earlier. Finally, we continued to strengthen our balance sheet, ending the year with a net cash position of $121 million, which represents an increase of roughly $45 million year on year. But let me now elaborate on some of the capital allocation priorities just mentioned, starting with our two organic growth projects, the Sabodala-Massawa expansion and the Lafigué development project. During 2023, we expect to invest $400 million across the two projects, with $170 million on the expansion of our flagship Sabodala-Massawa project and $230 million on our Lafigué project. At Sabodala-Massawa, we launched the expansion in Q2 last year after completing the DFS, which defined a high return, low cost expansion by building a 1.2 million ton per annum BIOX plant to treat the high-grade refractory ore at Massawa. Once this expansion is completed, the mine will be capable of producing in excess of 400,000 ounces per year and will rank as a Tier 1 asset in West Africa. The expansion is progressing well, with 55% of the capital committed. Importantly, costs are in line with expectations, and we are on track for the first production from the expansion project in Q2 next year. Late last year, after being able to demonstrate that our operating performance was on track, that our balance sheet was strong, and that the Sabodala-Massawa expansion was de-risked, we were pleased to launch the construction of Lafigué. It is going to be another Endeavour cornerstone asset with production of at least 200,000 ounces a year, with all-in sustaining cost below $900 per ounce over a plus 10-year mine life. Construction activities have ramped up fairly quickly, as you can see, and we are on track for first production in Q3 next year. I will let Mark walk you through a more detailed update later on for both projects. Another important contributor to our growth has been and continues to be our exploration success, which has led to the discovery of 15 million ounces since 2016. In 2022, we discovered 3 million ounces of M&I resources, with significant discoveries at our flagship assets, as well as the major Tenda-Iguela greenfield discovery. Given the success of the 22 exploration program, we are pleased to reiterate that we are on track to achieve our target of discovering 15 to 20 million ounces of M&I resources at a discovery cost of less than $25 per ounce for the 5-year period ending 2025. As you can see on the chart with the shaded area, we've discovered 6.5 million ounces of M&I resources, or 40% of our 5-year target in the last 2 years, with most of the success coming from our flagship assets and greenfield properties. Looking ahead, we have committed a further $70 million to the 2023 exploration program, and we will continue to focus at our mines to extend their lives, while dedicating significant efforts toward greenfield exploration opportunities, with Tenda-Iguela being the priority. Tenda-Iguela is a good example of the opportunity in West Africa and our ability to unlock it. At this time last year, we were just getting the initial drill results. And given what we saw, we quickly prioritized the property, leveraging our shared technical services in the region. We progressively increased the program to over 60,000 meters of drilling, This agility, coupled with our large presence and size in the region, gives us a strong competitive advantage. So far, we have 1.1 million ounces in the indicated category and another 1.9 million ounces of inferred, all achieved in less than 15 months at a cost of less than $10 per ounce. And we see huge potential for this property and believe it has the potential to be a Tier 1 asset. In 2023, we plan to drill more than last year with a 70,000 meter drill program planned to delineate the mineralized trend and test new targets as we see several nearby targets that are geologically similar to the Assafou deposit. I would like to take this opportunity to thank Patrick Buisset, who retired as EVP Exploration and Growth at the end of the year, for all of his work over the last 7 years, helping to build Endeavour's portfolio and generate an exciting pipeline of growth opportunities for Jono and his team to advance. We're also very happy that Patrick will be joining the board in May, subject to approval at the upcoming AGM, to continue providing guidance and support to the team. Another important capital allocation priority is our shareholder returns program. Last year, we delivered nearly $300 million of dividends and share buybacks, which was double our minimum dividend commitment of $150 million for the year. This reiterates our commitment to paying supplemental shareholder returns, particularly in this strong gold price environment. To put this into context, it means that $212 per ounce produced was returned to shareholders, or to put it another way, 12% of our revenue was distributed to shareholders. It corresponds to nearly 30% of our operating cash flow and 2/3 of our adjusted earnings. It also means that we return an attractive indicative yield of 5.8% for the full year. What is impressive is that on a cumulative basis, our shareholder returns program has delivered nearly $640 million since we paid our first dividend in Q1 of 2021. It means we've returned approximately 13% of our market cap over the last 2 years. Another way to look at it is that we delivered significantly more than the capital required to build a new mine. So looking ahead for 2023, we expect also to supplement our minimum dividend commitment of $175 million with additional dividends and buybacks. And looking even further out, once we finish our current 2 builds by mid-next year, we then expect to refocus on further strengthening our balance sheet and increasing our shareholder returns before launching any new build. On a similar theme, in order to minimize shareholder dilution, in February of this year, we settled our convertible notes through a combination of $330 million in cash for the principal amount and with 835,000 shares worth $20 million and equivalent to 0.3% of shares outstanding for the in-the-money option value. The convert ended up being a low-cost financing solution which had a 3% coupon and an implicit cost of capital of 4.1% over the life of the notes once incorporating the value of the in-the-money option. Thanks to our strong cash flow generation and disciplined capital allocation, we improved our balance sheet position during the year, ending with a net cash position of $121 million, and we expect to maintain low leverage throughout our current construction phase. Before handing it over to Joanna, just a quick word on our ongoing sustainability initiatives. We've mentioned many times that mining has the potential to be one of the most impactful industries in contributing to improvements in living standards, particularly in West Africa. A great example of this is our Endeavour Foundation, which we established in 2021 to implement a range of sustainability projects at a regional, national, and cross-border level. This past year, we've launched 5 initiatives across education, health, and the environment. In Côte d'Ivoire, we are providing literacy classes to 500 community members around La Figue and training 150 youth in key vocational skills to improve their accessibility to employment. In Burkina Faso, we've signed a 3-year partnership with 5 universities, which will benefit 60 students a year and support the continuing development of the mining industry with much needed skilled professionals. Malaria, as you know, is a health priority for Endeavour. Working with the Burkinabe Ministry of Health, we have launched a pilot program called One Village Without Malaria, where we hope, through dedicated efforts and education, we can eradicate malaria cases for the whole community by the end of 2023. And our last project is supporting the Great Green Wall, which aims to slow down the advance of the desert that has been accelerated by climate change through the construction of a green belt from Dakar to Djibouti. We are doing our bit and financing the reforestation of more than 100 hectares a year in the eastern part of Senegal. These education and health projects are carried out in partnership with global experts and local authorities and will deliver a significant change in people's lives, offering them opportunities that weren't there before. I will now hand over to Joanna to walk you through our financial results. But before I do, I'd like also to take this opportunity to thank Joanna, who will be leaving us next week and will be replaced by Guy Young. On behalf of everyone at Endeavour, we wish you all the best in your future.
Thank you, Sebastian. It has been a privilege to contribute to Endeavour's success. Starting with our quarterly production, you can see that it has increased by 3% in Q4 over Q3, while our all-in sustaining cost was relatively stable with Q3, changing by 1%. What is more interesting on this chart, as you can see, is the consistency of our performance across the quarters over the past year, despite seasonality linked to the wet season, which really highlights the benefit of a more diversified portfolio and our operating experience. With respect to the full year, we achieved our guidance range on both production and all-in sustaining costs. Production from continuing operations decreased by 3% due to lower production at Boungou, Mana, and Wahgnion as a result of mining and processing of lower grade ore. Our all-in sustaining cost increased by 5% compared to the prior year, mainly due to increases in all-in sustaining cost at Boungou and Wahgnion, while inflationary pressures across the group were partially offset by favorable foreign exchange movements as the euro declined against the dollar. While we are engaged in construction of our 2 growth projects, our revenue protection program is providing increased cash flow visibility, which allows us to continue investing in our operations, growth, exploration, and paying shareholder returns, while still maintaining a robust balance sheet. In addition to the collars and forward sales we have in place for 2022 and 2023, we have added additional collars and forward sales for 2024 as we finalize construction of our 2 development projects, which are expected to start in Q2 and Q3 '24, respectively. During 2022, we realized gains of $20 million on our forward sales and collars. And for 2023 and 24, we have locked in average prices of $1,828 and $2,033 per ounce, respectively, on the forward sales contracts. The collars have floor prices of $1,750 and $1,807 per ounce, respectively, ensuring that we generate healthy margins from those protected ounces. Our operating cash flow before working capital from continuing operations increased 44% in the fourth quarter as income taxes paid were significantly lower, following withholding tax payments in the third quarter. This was associated with upstreaming cash to increase our offshore cash to settle the convertible notes, which we did in February. In addition, we saw higher production, lower costs, and the higher gold prices, which contributed to our higher operating cash flows in the quarter. Here, you can see a bridge of quarter-on-quarter operating cash flows. The realized gold price, including the impact of gold collars and forwards, increased by $21 per ounce in the fourth quarter, as gold sold increased by 14,000 ounces compared to the third quarter. Operating expenses and other items increased by $8 million compared to Q3 due to the impact of higher fuel prices and consumables impacted costs. Income taxes paid decreased by $49 million compared to the third quarter, largely due to the withholding taxes associated with upstreaming cash in the prior period. In addition, the quarter's operating cash flows benefited from an $83 million change in working capital due to an increase in trade and other payables related to the timing of supplier and other payments. As such, the quarter-on-quarter operating cash flow increased by $157 million to $311 million for the quarter. For the full year, operating cash flow before working capital from continuing operations amounted to $1.1 billion. This was slightly lower than the prior year due to slightly lower production and higher costs, which was offset by the higher realized gold price. We continued to grow our net cash position year on year, as you can see from this net cash bridge. We ended the year with $121 million of net cash. Full year operating activities generated $1 billion, which we allocated to investing and our operations and growth, as well as increasing our shareholder returns. Cash used in investing activities amounted to $521 million and included approximately $380 million in sustaining and non-sustaining capital expenditures and $122 million in growth capital cash flow, primarily related to our 2 organic growth projects. Cash used in financing activities included $269 million in paid shareholder returns, $57 million in dividends to minority interests, and $47 million in payments of financing fees. Finally, the value of our cash held in euros and CFA decreased during the year due to the strengthening of the US dollar, which resulted in a $71 million decrease in our net cash. At year-end, we had a robust net cash position of $121 million, and our liquidity remained strong with $951 million of cash on hand and $575 million undrawn on our upsized RCF. Adjusted net earnings increased 29% quarter on quarter to $93 million. I will not go through every line item in this table, but I will highlight the key items. Our earnings from mine operations was relatively consistent with the prior quarter, reflecting the stability of our operations, even in a higher cost environment. We incurred an impairment charge as shown of $360 million, which includes $163 million allocated to Boungou and $197 million allocated to Wahgnion. The impairments follow updates to the life of mine plans, which reflect an updated evaluation of the reserve and resources, including exploration potential, and higher operating costs at both mines, as well as increases to the discount rates used in the valuation. The loss on financial instruments in Q4 decreased from a gain of $60 million in Q3 to a loss of $10 million in the quarter, due primarily to unrealized losses on gold collars and forwards, offset slightly by the strengthening of the euro relative to the US dollar in the quarter. In determining our adjusted earnings, we adjusted the impairment charge, other expenses, the net loss on financial instruments, the net loss from discontinued operations, as well as other non-cash adjustments. Our adjusted net earnings amounted to $93 million, and our adjusted earnings per share amounted to 26 cents per share for the quarter, which marks a 4-cent increase over the third quarter. I'll now hand it over to Mark.
Thank you, Joanna, and hello to everyone joining us today. Before I jump into our mine-by-mine detail, I want to talk briefly about our safety performance. Whilst we have built up a strong safety culture, we are always conscious that even one injury is one too many. Unfortunately, last year we had a fatal accident at our Ity mine when a contractor passed away during a blasting incident. We extend our sincere sympathies and support to his family, colleagues and friends. The results of our investigation identified the need to review and update our site blasting evacuation procedures, which has been done and rolled out across the group, with the aim of preventing similar incidents. We continue to prioritise safety with our zero harm target front and centre. And as you can see, we have a sector-leading lost time injury frequency rate, which we are continuously working to improve through numerous training initiatives. I've just returned from a month-long trip across West Africa, visiting all of our mines, and I continue to be impressed with the levels of commitment and motivation I'm seeing from our operating teams, as well as the positive impact that several of our optimisation initiatives are starting to have. I am pleased to report that the team is approaching 2023 with the same levels of motivation and cost discipline that have helped us achieve such a strong 2022 performance. As Sebastian mentioned earlier, we have delivered very strong production and cost performance for the year, achieving the top end of production guidance within our all-in sustaining cost guidance. Here you can see a breakdown of our full year performance by mine. Outperformance at key mines, including the Houndé, Ity and Mana mines, reaffirmed our strong performance for the year and offset performance at the more challenging Boungou and Wahgnion mines. Our overall results demonstrate the value of having a diversified portfolio where we can balance performance across the assets and leverage the strength of our teams across the region to ensure that we can continue delivering against our key objectives. Before I go to the individual mines, I want to walk you through the year-on-year evolution of our reserves and resources. Overall, group reserves declined by 1 million ounces due to mining depletion and the lag in converting resources to reserves and modelling changes to incorporate higher operating costs while maintaining the gold price unchanged for our key assets. The group measured and indicated resources remained flat due to the 3 million ounces of discoveries made during the year, mainly at the Ity, Tanda-Iguela and Bantou projects, offset by mining depletion. Last year, given the long mine lives across our key assets, we took the opportunity to do more greenfield exploration, and as a result, we made a large discovery at the Tanda-Iguela greenfield property, which will be a large focus for us this year in order to identify additional inferred resources and convert existing inferred resources to the indicated status. In addition, we will also focus on delineating further near mine resources on all of our assets. Moving on to our mine-by-mine performances. At our flagship Sabodala-Massawa mine, Q4 versus Q3 production rose significantly as we focused on mining and processing higher grade ore from the Massawa Central and North Zone pits. All-in sustaining costs also improved significantly during the quarter due to higher production at higher grade and lower processing unit costs, due to lower maintenance costs and the 15% decrease in heavy fuel oil prices in Senegal in Q4. Looking ahead to 2023, while we work on the expansion project, we will continue to look at opportunities to optimise the mine's performance. During the year, we will be finishing ore mining at the Sabodala pit in preparation for in-pit tailings deposition. Another area where we are optimising is predictive maintenance of mining equipment, where we have had lots of success recently, increasing our dump truck tyre life by 35% over the last 2 years. The Sabodala-Massawa expansion project is progressing very well and will add around 200,000 ounces a year for the first 5 years of production at an industry-leading all-in sustaining cost. We've now committed 55% of the initial capital and costs are in line with our expectations. As you can see, we have made significant progress since we launched construction in April last year. I'm pleased to report that we are well on track for our Q2 2024 startup. Bulk earthworks are now complete and the civil works are progressing well, with foundations laid for the key crushing, milling and the BIOX reactors. Welding of the stainless steel BIOX reactors is progressing well. This year we are focused on constructing the balance of the processing plant, the power plant, the new TSF, so that we can start ramping up BIOX reactors as soon as possible to give us a head start on processing. Moving on to the Hyundai mine, I am particularly impressed with how the asset has matured in the past 5 years, resulting in record production last year due to both production occurring from the recent discoveries made and optimisation efforts. For much of the year, we continued to source high volumes of high-grade oxide ore from the Curry Pump pit, which along with incremental improvement initiatives in the plant helped us to process over 5 million tonnes per annum for the year, which is a new record for Hyundai. These incremental changes were not made overnight. In fact, for the last 5 years, we have been progressively optimising the plant, adding a SAG mill feed optimisation, upgrading the feeder and adding controls to choke feed the pebble crusher, which has driven progressive throughput improvements. We are not done yet and are working on plans to further optimise throughput through low capex initiatives, including looking at ore sorting, crusher speed, feeder spacing and adding an oxygen plant and pre-leach thickeners. Onto our next mine, Wahgnion, where production decreased year over year due to lower grades at that Nogbelly pit and came in slightly below production guidance and above cost guidance for the full year. During Q4 last year, we started mining and processing ore from the higher grade Samavogo pits, where reserve grades are over 2 grams per tonne, and we noted significant improvements in head grades in Q4. In 2023, we will continue mining from Samavogo and blending with lower grade ore from the Nogbelly pits. And in the second half of the year, we expect to start mining and processing ore from the Stinger pits, which have reserve grades over 1.6 grams per tonne. Samavogo and Stinger are expected to drive stronger year-on-year performance at Wahgnion, and in 2023, Wahgnion is expected to increase production at lower all-in sustaining costs. Wahgnion is a fairly new mine. In fact, it is our youngest mine in our portfolio, and it is comprised of a number of small pits. We are continuing to work on extending our ore body knowledge and advancing our grade control drilling programs to improve the scale of mine to drive higher production and lower cost. Now we turn our attention to the Ity mine, where we achieved record production, a 15% year-on-year production increase, and beat both our production and cost guidance for 2022. The mine's outperformance was driven by stronger than expected plant performance, coupled with mining and processing a higher proportion of high-grade oxide ore as mining advanced into the Le Plaque pit. Looking ahead to 2023, it is expected to maintain similarly high performance as we increase our focus on delivering our optimisation projects. These include the Resign Optimisation Initiative, which is expected to be fully commissioned early in the second half of 2023 and is expected to lower cyanide consumption, lower operating costs and improve recoveries. We are also advancing engineering work on the mineral size optimisation initiative, which will allow oxide ore to be fed by a simpler system than the current arrangement, especially during the wet season, which will decrease operating costs. Moving on to the Boungou mine, production decreased year on year and came in slightly below guidance, with costs above guidance as we processed less ore at lower grade as supply chain delays impacted delivery of fuel and some reagents to the mine. Looking ahead to 2023, production is expected to be weighted towards the back half of the year as higher grade ore becomes available in the West Flank pit, following stripping there in the first half. Boungou is expected to maintain similar levels of production and cost in 2023. At the Mana mine, production beat the guided range, while costs were in line with guidance. Strong production was driven by better than expected mining performance, particularly from the Wona open pit before it was depleted, and the Siou and Wona underground deposits, where stope production and development continues to advance well. At Wona, more than 6 kilometres of lateral development has now been completed, which is quite the achievement from the team at Mana mine. As you can see from the images, the declines at Wona have progressed considerably, and with open pit feeds expected to reduce towards the end of this year, we have commenced a third decline into the Wona deposit, which will provide additional feed to the processing plant. In 2023, Mana ore will be mainly sourced from the Siou and Wona underground operations, where stope mining is expected to continue throughout the year, supplemented by ore from the Mayula open pit. As a result of the higher proportion of underground feed this year, we expect higher processing grades compared to the prior period, with production and costs in line with the prior period. At our Greenfield Lafigué development project, we are building a 4 million tonne per annum capacity CIL plant, capable of annual production of over 200,000 ounces at a low all-in sustaining cost of below $900 per ounce throughout its initial 13-year mine life. The Lafigué project benefits from excellent infrastructure, and it is located around 20 kilometres away from high voltage power lines and a tarred road. In addition, the resource is a single pit, non-refractory ore body where high gravity recovery should sustain overall metallurgical recoveries of around 95%. I am pleased to report that construction is progressing really well. We've now committed 34% of the capital, and importantly, costs are in line with our expectations. We are seeing good progress against our critical path, and as you can see, bulk earthworks for the processing plant are now complete, and earthworks for the TSF and water storage facilities are progressing well. Civil works, including concrete foundations at the crushing and milling and CIL facilities, are progressing well, and ring beams for the CIL tanks are largely complete. Looking forward, the processing plant construction and power line construction are the key critical path items that we are advancing for this year, and we are on track for first production in Q3 2024. I will now hand back to Sebastian.
Thank you, Mark. As you can see, 2022 was a successful year for Endeavour as we delivered against our key objectives and continued to build on our track record of strong operational performance, disciplined capital allocation, and attractive shareholder returns. Over the next 18 months, our efforts to unlock near-term growth through the completion of the expansion of Sabodala-Massawa and the build of Lafigué will further increase the quality of our portfolio, increase our production, lower our cost, and enable enhanced cash flow generation. This in turn will allow us to further increase our returns to all stakeholders on a sustainable basis. As always, I'd like to thank my team and all our employees for their continued hard work and dedication. Thank you for joining us. I will now hand back to the operator for Q&A.